Hi everyone and welcome back to another video of Kiwi Investments. I have videos in the near future coming up which will benefit everyone, but in this video I will only be discussing stocks in New Zealand. So for those watching in other countries, I don't want to waste your time. Stick around if you're curious, or else I'll see you in the next video, which will be next week. I want to start off by apologizing for not posting anything for a while. I have been working on other things similar to this list that I curated here, and if those all go well, then I should be able to bring them into this channel and you guys should be able to use it as an extra resource for your investing. In this video, we will have a look at this table here, which we haven't done for a while. It shows what's happening in the New Zealand stock market throughout the pandemic, but we'll come back to this. First, let's talk about the free $15 mentioned in the title of this video. So this is for people who haven't signed up with Sharesies yet. If you use the first link in the description to sign up to Sharesies, you will get free $15 just for signing up. This is a limited time offer up until 23rd of August. After that, I think they're gonna take this back down to $5. So if you haven't signed up with Sharesies yet, this is the time to do it. Again, the link will be the first link in the description. Okay, now let's talk about the two companies mentioned in the title of this video. And these companies are Pacific Edge and QEX. Both of which are companies that I have invested in now because I won't talk about things that I wouldn't do myself. My only regret is not making this video sooner so that you guys could have gained this crazy gain with me. I apologize for that again. I will try to make YouTube a higher priority next time. So let's talk about these two companies. Pacific Edge is an innovative cancer diagnostic company, but right now their only commercial focus is on bladder cancer products, CX Bladder being their main product. The CX Bladder provides a new way of detecting and managing bladder cancer, and is far more cost-effective and accurate than what's out there right now. Now, this type of innovation is not as hyped or as exciting as Tesla, but at times like this is where these kind of products can really shine. And that's why I bought into it when I did. Because I knew the stay-at-home orders due to COVID will result in health companies looking at ways to diagnose and treat people while they are at home. And products like this would get pushed to be approved as soon as they can. My predictions were right when Kaiser Permanente, which is one of the largest healthcare providers in the US, approved commercial use of the CX Bladder. And this is the news that caused this big jump here. You can't really see it clearly with Sharesies, so let's go to Google. And if I were to highlight that bit, you can see that it jumped up 114% on that day. Following this news came more good news when Centers for Medicare and Medicaid Service, better known as CMS, said that they will reimburse Pacific Edge for all the testing of CX Bladder they have done. This is a huge milestone for a company like Pacific Edge and a lot of money. Currently, they are negotiating more for earlier tests they have done. Speaking of money, I don't bother looking at the company's balance sheet when it comes to companies like these because I know they'll be at a massive loss trying to get things off the ground. Researching and testing, for example, would cost a lot of money for them. So seeing this reimbursement coming through is massive news. So that was on the 3rd of July. And if you have a look at the stock price again, on the 3rd of July, which is over here, the stock price jumped another 114%. So from 16th of June to 8th of July or 7th of July, the stock went up by 361%. Crazy, right? And all this time I was thinking to myself, damn, I should have put some more money into this. And also, damn, I should have made that video so my subscribers would join in with me for this nice ride. If you go back to the share price of Pacific Edge, this little jump, the price jumped again around 20 or 30%. And that's because ANZ started investing in the company. They bought a huge amount of shares at 68 cents and the stock price has just been sitting around that area since then. So where to from here? Well, that's anyone's guess really. Other healthcare providers may look to include the use of CX Bladder in their service as well. And not just in New Zealand and America, but Pacific Edge has been working in Asia as well. But there are still huge risks involved with investing in companies like this. Like I said earlier, they don't have much commercial used products at the moment. So you're basically betting on one of their products. And if there's a better product than CX Bladder to enter into the market, or if anything were to go wrong with this product, Pacific Edge would be in big trouble. Scaling would also be a challenge because once the sample comes back from the patient, it has to go to a Pacific Edge laboratory where proper analysis and reporting has to be done. I want to make it clear here that I'm not telling anyone to invest or sell the stock. We are simply just discussing it and perhaps bringing new companies into your radar which you otherwise may have not thought of. If you have heard of these stocks or have looked into it, I would love to hear what you think of it. And on that note, let's move on to the second company. And that's another highly speculative company, and that is QEX. And I do love a story like this. This company was started by a husband and wife couple in their Oakland garage in 2010. And 8 years later, in 2018, became a publicly traded company. Can you believe that? QEX is a logistic company that makes it easier for manufacturers to do business with China by cutting out the middleman and allowing their products to be sent directly to the buyer. QEX contains contracts with different parts of China, which provides quick and effective customs clearance. The company also has a warehouse in Shanghai Free Trade Zone where products from New Zealand are stored until it is ordered from individuals in China. Because of this warehouse and customs setup, it makes the delivery much faster. QEX operates its business through careful contracts with companies such as Countdown, Fonterra, and Anchor. The main source of income was generated from exporting health supplements and dairy products including baby formula and milk powder to China. Now let's have a look at their stock price history. Like I said, it was listed in 2018, and in the same year, it went up to about 250%. In fact, it was awarded as the 13th fastest growing company. But don't let news like this fool you, because do you remember GeoOp? GeoOp was also an innovative company that made software for workforce management, and it was named one of the fastest New Zealand growing companies. And if we come and have a look at what happened to them, they are now trading at 6 cents per share. So that's the trouble with innovative companies. Anyways, let's come back to QEX. And the reason why I'm looking into QEX is because they have expanded into Australia now as well. So there's more revenue coming in and diversifying their customers. They just announced their earnings report and their revenue has increased 5.6%, but their profit after tax has decreased 40%. And I think that's why the QEX share price has been flat for a while. Things have not moved. This earnings report was released on the 24th, so that's Friday last week, and the stock price hasn't moved too much since then. And I think that's because investors are happy with the money that they made in Australia, but they're still worried about the net profit being down 40%. This is a company that's just starting out as well, so it's very speculative on what's going to happen next. So do your own research before you invest in companies like this, and only invest what you're comfortable with losing. Companies like this are also very fragile. So if you come back to the share price history and go max again, it was doing well when it first got listed, but then it started going downhill. So companies that are just starting out and are small are very vulnerable to the news and can be easily be bullied by competitors. So that's why the stock prices started going down, because one of their competitors aggressively started cutting back the margin cost, which QEX couldn't keep up with. Since then, there have been other news that caused the price to keep going down. Another disadvantage of investing in companies like this is that most people invest in small companies, or penny stock if you want to call it, to make some quick money. The problem with that is that you would need to know when to buy in and when to sell. So you had to be right twice. Let me give you an example of what happened to me this month. So if I come back to my Sharesies portfolio and have a look at a company called Plexure, come down a bit, you see that I also bought into it and I predicted it would go up, and I bought in at around 96 cents per share on the 19th, and I waited for it to go up, and there was this big gain, and I thought this is the gain that I've been waiting for, and I sold it on the 16th of July at $1.17. But look what happened after that. It kept on going up, and that was also a little bit more painful. So that's what I mean. Companies that are small, not paying dividends, most people want to sell it and make a quick buck, but you got to be right when to sell it. I also want to point out that you still can make big gains from a much well-known company, such as blue chip companies. So if we have a look at my portfolio, come down a bit and let's have a look at Fisher and Paykel and Mainfreight, which are well-known companies and pay dividends at least twice a year, and they still have a pretty good gain. So my Fisher and Paykel is up 46% and Mainfreight is up 21%. So you don't need to go and look for small companies to get those impressive gains. Bigger companies, blue chip companies that are better established can also give you the same gains from time to time. And I feel like it's much safer as well. And that is why when I'm investing in small companies, I invest only small amounts. And to be honest with you, I invest in small companies just because it's fun. So if I go to Fisher and Paykel, come to my investments and I go down, most blue chip and well-established companies pay dividends. Small companies like the two companies that I talked about won't be paying dividends, or very unlikely to be paying dividends. Blue chip companies pay dividends, and they also can have a pretty good gain. I nearly made $1,000 from my Fisher & Paykel investment, or 46%. Anyways, those are the two companies. Let's come back to my table that I made. Alright, now, so just a quick recap, or for those who haven't seen this table yet. The first column has the company name, the second column is the ticker of the company, and this blue column is the price the company was trading at on the 20th of February this year. I picked this date because this is the date before COVID caused all the share prices to go down. And next to it in the light blue column is the price closed on the 24th of July, which is last Friday. And in the red column, I have the lowest price the company was trading at since the 20th of Feb up till today. Next to it is the percentage change. Next to it is the current share price right now. And in the green column is how much the price has changed since the lowest point. And in the light blue column again is how much the price has changed since last Friday, which is the 24th. And in the blue column is how much the price has changed since the 20th of February this year. So for example, Air New Zealand was trading at $2.23 on the 20th of February. And it went all the way down to 80 cents, which is a 70% difference. The current share price is trading at now is $1.34, which is a 67% different since the lowest point. Air New Zealand was trading at $1.33 last Friday. Let me just highlight this so it's easier to read. Air New Zealand was trading at $1.33 last Friday, which is a 0.75% different this week. But overall, Air New Zealand is down 50% since the price recorded on the 20th of Feb. Now let's change these around. Let's change this from highest to lowest just to see who were the big gainers this week were. And like I said before, Plexure Group is something that I'm kicking myself over because I sold it too soon. And fourth down from the list is Mainfreight. Like I said, Mainfreight is a well-established company and they're still having some good gains. Well, this increase was because they released a financial statement this week and it was pretty impressive. Going down a bit, we still have Pacific Edge still going up. Tourism is starting to kick back in now. Still a bit risky in my opinion. And if you come back up here and change this from lowest to highest, you see the biggest losers. Westpac Banking because finance isn't doing too well right now. Sky City is still missing their very important Chinese customers. Kathmandu has been very volatile these days. And if you come to the darker blue column and change this from highest to lowest, these are the biggest gainers since the 20th of Feb. Pacific Edge, the company that we talked about, which benefited from the lockdown. Pushpay was another company that I bought and sold. And again, I may have sold it a bit too early. Actually, let's have a look at that. I'm actually curious to see if I did sell it too early. And there we go. It's another company that I thought will increase a lot. So I bought in and I sold it too early. And I missed all this big gain. I should have just held it. Let's go back to our table. So seeing this is a little bit painful to me, to be honest. Pacific Edge, Pushpay, and Plexure are all companies that I have invested in. But Plexure and Pushpay are companies that are sold too early. So that's painful. Anyways, let's keep playing around with this table. Now let's change this green column from lowest to highest. So these are the companies that haven't recovered or is slow to recover from the pandemic. MCK is an interesting one. They released their earnings report this week and it was better than expected. So that might be something to look at because they still have a lot more way to go to recover to what they once were. Still, it's a bit risky though. And Z Energy is another interesting one. They released their quarterly earnings this week and they showed that the retail trading conditions were back to normal, but they're still not making that much money from jet fuel. So I think once plane starts flying and the use of jet fuel comes back up, this may be a winner. But you also had to consider the environmental trends these days. If they start paying the impressive dividends that they used to pay, this may be the next top gainer. Anyways, I'll stop talking now. And what I'll do is I'll change this from A to Z and I will go down slowly. So if you see a company that you're interested in, you can pause the video and have a look at what's going on with the stock price. Thanks for watching. If you haven't signed up with Sharesies yet, don't forget the $15 link. If you're using another platform to trade stocks with, I would recommend using that link anyway just to get that free $15 since it's free and you don't have to do anything but sign up. Like and subscribe for more videos like this. I got another video coming up soonish. It'll be different to this and I will see you in that video. Take care and bye for now.